Hey everybody, this is Matt Sheridan and Cynthia Pierce with your ATL agents, trying to bring you more knowledge through information. And today we are interviewing an appraiser, not just an appraiser, but one that we've used somehow. Luckily, she's been chosen to appraise a lot of our properties, and she is here with us today.
Hello, Jennifer. We're so glad you could come today and help us out understanding appraisals. And you've been doing appraisals for how long now?
I have stopped counting at 20 years. It's roughly 23, 24, somewhere around there.
So you basically started when you were 2.5.
I did, yes.
And tell us your name and your
21.
full name and company that you work for.
So my company name is JT Valuations. It's been my company since 2005. So I've been a one-woman show for a very long time.
Nice. Well, we keep running across you in different appraisal needs. Different lenders send out an appraiser. It's always independent. And that's how we met, right? Just
That's right.
meeting you at a house because we like to show up to meet the appraiser. And, we were just happy to know you and we're happy that you will share your expertise with us and with our clients. So we had a couple of questions. Could I ask you one to start?
Absolutely.
So we feel like we're in a bit of a different market now, and it's pretty well understood by everybody. What are your challenges in this current market, and do you feel that it's different? If so, how are you experiencing it in your world?
And it's what's so different about it is that it varies from zip code to zip code. It can vary from school district to school district. It varies wildly. I have houses that are still getting multiple offers and that we're dealing with appraisals that are over contract prices. We have houses that are sitting on the market for quite a long time. And to speak frankly, I can't always follow the rhyme or reason, like you've got your markets that are more investor driven, say lower price markets, investor driven, that you're seeing a lot of saturation and a lot of oversupply. And so those markets are doing as well. Then you've got your markets like in Dunwoody, Sandy Springs, north of Atlanta, that still have a huge amount of competition, that are getting multiple offers, that are not on the market for very long. So it's really taken a huge analysis of each market. And just as of February, we have been asked by Fannie Mae, it's a new guideline that we have to dig deeper in our analysis of the market. Going back 12 months, comps that sold back in April, maybe they get a positive adjustment or get a negative adjustment because the market was hotter back then. They really want us to, instead of using broad strokes to cover our market analysis, they want us to get really in depth. They want to provide graphs. They want us to talk at length about the differences in the market. So honestly, trying to use sales that are a little bit older can be a little dicey because being able to support that they're still relevant in the current market is you have to be able to do that. But then you have neighborhoods that things haven't sold recently and that the older sales are all you have to really give a basis. So it's a challenge. There's more kickbacks recently about appraisals than there have been, I would say, 3 months ago.
Well, that's what I was going to say. Have you seen, like, in the past 2 years, there hasn't really been a house that hasn't appraised. I mean, It's very hard for it to be sent back and say, hey, this seems to be overvalued. You need to have a secondary opinion or you need to adjust. And we actually just saw that recently. And it's the first time in almost 3 years that we've had that. You said you're seeing that more currently?
I'm seeing it. I was actually the one who appraised something, came in under contract, first time happening in 10 years, and you can't argue with the numbers, right? And so I think that the underwriters, everybody in the financial institutions are being more careful. They're watching the market fluctuations. They're wondering whether the comps are telling the right story that we're providing, and just really wanting to make sure that we don't have a repeat of what happened, 2010. Yeah, exactly. So I think that things are just getting scrutinized a little bit more than they once were. And so in my opinion, it's best just to try to go ahead and use, I want my comps to be within 90 days, if at all possible. It's not possible always. 6 months, if I have to go back a year, which I'm doing on an appraisal that I'm currently working on right now, but I'm going to have to write, a 2-page narrative as to why I'm doing that.
Wow. You know, it did bring up one more question. I know you have a question, but when you mentioned that you kind of see two different things happening, homes with multiple offers flying off the market, and then homes that sit and it's not 100% explainable. One of the things that I feel like we've encountered is if the house is move-in ready, like move-in ready, fresh paint, fresh carpet, looks neat, mechanically maintained, it flies off the market versus the ones that need work. And I feel like that's kind of a tale of two different markets. And we do have listings staying on the market longer when they do need work. And I think my guess is that a lot of the buyers don't have the cash right now, especially in the, mid to lower price ranges. Like even in the up to say 800,000-900,000, I still think they don't have an extra 100K sitting around to go in and do the new kitchen and do the new bathrooms and do the flooring, and it sits for a while with prices.
I agree with you. That's what I would say.
Yeah, and that was going to be that was going to be one of my questions is, based on a house that's been renovated and all this stuff, like for our sellers that are coming to the market and for our buyers, what is one of the most valuable things for an appraisal that can increase the value of their home? Is that adding a bedroom, adding a bathroom, updating a kitchen, et cetera? I mean, I know y'all are more numbers, nuts and bolts type things, but you have to look at the aesthetics as well. So can you speak to that at all?
I can speak to that. And people will ask me this question, and my biggest piece of advice is we really look at effective age. The house can be 65 years old, but look like it's 3 years old, or it could be 65 years old and look like it's 50. Yeah. And so you can renovate kitchens, you can, add bathrooms, add bedrooms. But honestly, my biggest piece of advice is always just keeping your home looking as young as possible. Like even if maybe say your kitchen is a little bit dated, but you've maintained it really well. So there's not a true formula to what would add the most value, but I feel like the ones that are maintained the best, that look the youngest, I don't always adjust based on actual age because really it's effective age. It's really how well that house is being taken care of. Unless you're dealing with newer construction, then it's kind of all the same. But these homes that are up in Dunwoody that are maybe built in the 60s, 70s, 80s, but they're renovated and they look brand new and they've been maintained mechanically and systematically. And I feel like that's your best way to get the most value.
Shocking. Maintain your house and you'll maintain the value.
I know.
Like, don't let it fall apart, please, sellers.
Yeah.
Well, it's funny because I just toured a home that was 1995 or something and nothing had been changed. Nothing. Like wallpaper, everything was there. And obviously they discounted the asking price, but I still believe that by the time you add up a large home with everything needs touching, it's overwhelming to a lot of buyers.
It is, and I think the 90s especially may have not been our best time in architecture. No offense to anybody.
Like the dark one. Tuba granite. I mean, come on.
Yeah. I mean, kind of going back to what we were talking about a few minutes ago to add on, I also feel like there is a shortage in our market of homes in a certain price point that, they're either not what people want because they're not nice enough, they're too low, or you've got everything over 1.2. You know what I mean? There's a sweet spot that we're really missing. And I think
What's that range?
I would say 758 to 1, somewhere around there. Like I was talking to some people yesterday and they already sold their house and they're looking for something and they cannot find anything in the $900,000 range.
Yeah, so I mean, that's like what we're seeing is most homes that are being built are $2+ million because the cost to do it now is astronomical. So these builders aren't buying a house and flipping it. They're tearing it down and putting up a monster because it's the only way that financially makes sense to them. That is a struggle, especially even in Dunwoody. I mean, between 750 and $1,000,001, even maybe $1,000,002, there's not a lot of inventory. So anybody that's looking in that range for their next upsize of their house, there is nothing. So you either have to think about, I'm going to a 1.5 or higher, or I'm going to spend money and fix my house up, or they're going to do that, or they're going to have to buy a fixer-upper that has good bones and just, so it's a hard decision to make. And with, the challenge with rates in the market and everything, it's just
it's a big challenge. And nobody wants to buy a $900,000 renovation project, right? Like that's not a big market for that. That's what you'll see. Nobody wants to do that. If you're spending that, you want to be able to move in and live there.
Exactly.
Maybe you'll do some lighting as you can.
I know.
Some paint. Well, also, I think that kind of dovetails into the question that we were wondering how you would address if some of our friends and family and clients want to refinance as soon as the rates drop a little bit more. What is the difference in an appraisal for a buyer, a new loan, new everything versus a refi person? Because somebody may want to refi, take cash out and do those renovations, which we kind of recommend. What's your thought on a buyer appraisal versus the refinancing appraisal?
Honestly, it should be the same. I mean, the definition of an appraisal, as we're taught, is an opinion of value as of an effective date. So the purpose should not matter. We use the same methodologies. If I'm doing a refi appraisal, it's on the same form. I'm beholden to the same standards. It's going through the same underwriting process. We're using the best comps. We're adjusting them the way that we would adjust them, no matter the purpose of the appraisal. A lot of people do think hey, I'm doing a refi, so let's get it as high as we can. Like, I understand that thinking, and I can understand why you would want it that way. However, the value should not change, honestly. If I'm appraising a refi versus something that's under contract, there shouldn't be a huge delta between the two values whatsoever.
And I would probably say that would be illegal.
Yes.
Probably not, probably frowned upon. I mean, I think you passed the test on if it's different, but it shouldn't be any different.
It shouldn't be any different. I mean, when you're appraising a house, you have a range of adjusted sales prices. And so your range, your number is going to fall somewhere in that range, whether it's on the lower side or the higher side. So I can see me versus somebody else doing it. There may be a difference there, but truly, it should not matter the purpose of the appraisal whatsoever. A divorce, estate, refi, purchase, it should all really be the same.
That's great to know. I had heard that because the bank has less risk when you own the house, they might be a little more lenient in their requirements.
They are not.
Oh, good.
Well, like, speaking to that, sorry, go ahead.
No, go ahead. That's what I say. Just they're definitely not. They are holding you to the same standards.
Yeah.
They want to make sure if they're going to loan money on a refi that they're going to pay it back, and that if they do have to take it back, that it's worth what we say it's worth.
Right.
So that's really the biggest risk factor, So.
And we had a corporate relo that we had to get 3 appraisals on, and they were $175,000 apart. And I was like, I'm confused on how this can happen. So it was big, and it was but one was extremely off, and the other 2 came in very similar. The corporate hired these people, but that's why they did it, because it was like, we have to have a third one because that was way too.
Somebody just went to sleep when they were filling it out.
It doesn't happen frequently.
But I will say that also, when that does happen, I wonder, does that appraiser know the market? Where did they come from? Especially if you're working in the city of Atlanta, any of the suburbs around Atlanta, you really need to know the market. Everything is different neighborhood by neighborhood. And I'm not saying an appraiser is not a good appraiser because they live north of the city. I'm just saying that maybe if they don't spend a lot of time working here, they're not going to know the ins and outs of our market. I've done appraisals in Buckhead where someone would tell me like, hey, I had an appraiser come in here and they appraised it for this amount, and I'm shocked because it's way below what it should be. I mean, way below, and so it's really about knowing your market. I'm not going to take appraisals in Woodstock because I don't know Woodstock's market. So I don't think that the inverse should happen, honestly. I mean,
great point, right?
Not to speak about a city specifically, but, just trying to stay within your neighborhood.
Yeah.
Wow, this is great. Do you have any more questions we need to get answered today? Because we would like to have part 2, Jennifer.
Yeah, when all the things change.
Yeah, well, we need to stay current with these ideas that you're sharing with us today. And I think our clients are going to be very happy to understand the appraisal aspect a bit more. And, the deep dive is really the best.
And I don't want to embarrass you at all, but for anybody that's watching, this is not what a typical appraiser looks like. So when I met Jennifer, I was like, oh, okay. I was expecting you. I wasn't expecting you, but I was expecting an appraiser. So that was funny. We can take that off if needed, but yes.
Compliment.
No, you should have seen when I was 23 trying to tell people that I was an appraiser. So I have age on my side now. So
I never had that problem.
Oh my gosh. Too funny.
No, we appreciate it. We appreciate your energy too, because the
Yes.
first time I met Jennifer, she's like, I'll be out of here in 20 minutes. And I'm like, what can I do? She's like, I've already done it.
Yeah.
Boom. She moves fast.
Yeah.
I move
It's good.
fast. Most of the work is done in the
Yeah, you've
office.
already done your homework. Hello.
I've already done my homework. I can measure a house really quickly because I've been measuring houses for 20 years, so there's just things that come with age and experience, and I'm proud of that. And I'm able to do a lot of volume that way too. So it's good for me.
But we loved it because we were very impressed, and we kind of move fast ourselves, but I don't believe I would keep up with you.
Jennifer, thank
really
you so much
Yeah.
for your time. I appreciate this. And we look forward to doing this again.
Yes, absolutely.
I'd be happy to. Absolutely. Yeah, anytime.
All right.
Thank you so much. See you later.
Okay,
And
bye-bye.